Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's episode, which is the first of a two-part series I'm going to do on behavioral finance, a primer, if you will. Behavioral finance is the intersection of behavioral psychology and finance. It informs all of our financial decisions. It explains why people make financial decisions, including irrational ones. So an awareness of behavioral finance helps to make, or I should say, helps to mitigate emotional driven decisions that can lead to bad outcomes, that can be bad decisions. As I said, it's a two-part series. In this first episode, I am going to talk about three behavioral finance biases. The first is anchoring. The second is confirmation bias. And third is recency bias. So let's start with anchoring. Anchoring is a cognitive bias. Actually, all three are. And it is the situation where one relies too heavily on the first information that they encounter. The early information gets a lot of weight. This initial information can significantly influence subsequent decisions. The crazy part of how we are hardwired, and there's lots of academic and social research on this, is that it impacts decision making, even if this early information is irrelevant or arbitrary. It's just, again, how we are hardwired. So how this plays out, I'll give you a quick example in finance. A good example is if an investor buys a stock, and let's say it's at $50, they are likely to be anchored to that $50 price. Whether the price goes to 100 or to 20, the $50 will have a lot of weight in their mind. That is where they will start their decision making from. But it's faulty. I'm reminded of Jim Cramer, the very popular MSNBC financial guru, I guess, has the show Mad Money. He, when callers will call in and say, I bought a stock at a certain price, he'll say, it doesn't matter what you paid for it. It matters where the stock is going. He further says, I think on air, I've certainly read it in his books, he talks about wisely, nobody cares the price you paid for a stock except for you. The world simply doesn't care. But that's a good example of anchoring. You pay $50 for it. If all of your decision-making flows through the reality that you paid $50, you're likely to make flawed decisions because nobody else cares. And it's really only meaningful to you, not the world around you. So that's a quick summary of anchoring. There are many, many other examples. Hopefully you could observe some others if you think about this. The next thing I want to talk about is confirmation bias. This is a bias that you see in behavioral finance, but you also see elsewhere. I'll touch on that in a moment. But this cognitive bias, confirmation bias, is where you seek out information that aligns with your world view. You also avoid or minimize information that contradicts your worldview. So if you start out with the premise that you are bullish on the stock market, where you believe it'll go up, confirmation bias says that you will seek out information that reinforces that original thinking you had. And if you came across an article or an interview that was contrary to that, let's say was bearish or negative about the prospects for the market, you might completely avoid that information and not want to participate in consuming it. Or you might listen to it or read it, but you might greatly minimize it and not give it its due respect because it runs contrary to your belief. That's confirmation bias. I talk about this a moment ago, where you see this in a lot of ways, and I'm going to talk politically for a moment. It's 2024. We have a presidential election coming down the pike. I've experienced this in the last couple of elections. It'll probably be the same thing. Whoever wins the presidency, within the next few days, I will have people that call that are worried that the sky is falling, that whoever was elected was going to ruin everything, and they are inclined to sell because X candidate won the election and will now be the president. I've talked about this on air before. I've talked about it. If you're a client of mine, this will often come up in our discussions. But when President Obama won the presidency way back in 2012, that seems like a long time ago, but it was 12 years ago, roughly. When he won, I remember having conversations with people that thought that everything was going to fall apart, that the worst economic calamity was about to hit us. And it was a function of this confirmation bias. They were not supporter of President Obama, didn't vote for him. And the confirmation bias presented itself in, I think everything is going to fall apart. Now, fortunately, if you look at the Obama administration, the stock market and the economy did fine. We could debate whether it could have done better, could have done worse. Was this policy good, this policy bad? But the sky didn't fall. I think we could agree on that at least. And you fast forward to 2016. In 2016, President Trump, an underdog, won the presidency. And I fielded those same phone calls in the days after his improbable election. Now, think about it. The people that called when Obama won were often not the same people that called when President Trump won the election. They usually were on a different side of the political aisle, but the conversation, the worry, the scare, the fright was the same. It's a great example of confirmation bias. And if you fast forward, by the way, to the election of President Biden back in 2020, once again, I fielded phone calls about how all heck was going to break loose and people were inclined to sell. My job as a financial planner is to remain unemotional and to rely on facts and figures and history and analytics as best as I can to avoid these biases. So that's confirmation bias. The last bias I want to talk about is recency bias. This is a powerful one also. All three of them are. This is a cognitive bias that leads people to believe that current trends and current patterns will continue, and they give undue weight to this. This plays itself out in market trends, in asset performance, and in economic conditions. We all know, generally speaking, the adage, buy low, sell high. And it's a true adage, and it makes sense, and it's very simple at its core, but it's often very difficult to carry out because of recency bias. If the market goes down, you could use a market, you could use an economy, you could pick an individual stock or an individual investment vehicle. When it goes down, most times it's difficult for people, because of recency bias, to picture anything other than the downward trend to continue. And that's why it's difficult to buy low. You do have to be a little bold, a little contrarian. I'll even say brave. I'm not talking about brave like military and first responders, but in the financial realm, a little bit brave. It's crazy because I've experienced this over my 30-year career. If I show someone something that has gone up a lot over the last 3 years, it's almost easier. It's almost an easier decision for them to invest in. But there's a lot of research that shows, and listen, not all of this works all of the time. So I'm talking in generalities, general principles, general rules. But if something's done great for 3 years, it may not do as great for the next 3 years. You have something called a return to the mean. And if something is hot, it will not always remain hot. And sometimes if I show somebody something that's done great for 3 years, they will easily say yes, but they may be making a poor decision. I might be making a poor recommendation, but it is easier. It's easier. You may not get good results though. On the opposite end of the spectrum, if I show someone something that has done poorly for 3 years, it is often difficult for them to envision a change in the trend, a change in the pattern. And I'm not picking on the people that I have as my customers and clients. It's human nature. This is how we're hardwired. I, as a professional, probably have an easier time managing these things just because of my immersion in the topic and awareness of these financial, behavioral financial elements. But we all fall prey to these things. I am not perfect, far from it. I've used the term "we are hardwired" several times. So we all have these biases, and I believe we've all made mistakes due to them. With recency bias, just to finish that thought. So this relates to market trends, asset performance, and even economic conditions. People generally believe that things will continue as they were, and that is the bias. And it's a little bit tricky because just because something went up for a period of time doesn't mean it'll continue to go up. And just because something went down for a period of time does not mean that that will continue. So having an awareness of the recency bias, like these other biases, can help us make better decisions in the realm of finance and probably even beyond that as well. I think the trick is, in my experience, my philosophy, I think the trick is to be aware of them so that you can manage them effectively. You can't get rid of them. You can't get rid of them. We're humans and we're all flawed, but there are some tools you could do. Being aware is one I've already mentioned. Another one is working with others, communicating with others, sharing ideas. Could be your spouse, coworkers, family members, friends, because talking through things, they'll bring up, hopefully, if it's an open and honest discussion, they could bring up other vantage points, challenge you on your thinking, and help you work through problems, allowing you to arrive at better solutions and better decisions, at least hopefully anyway. It's an optimistic tone. As I said, our work here at Elliott Wealth Management as a financial planner is to help clients mitigate these biases. We want to have an awareness of our own biases because I have biases just like everyone. But we want to help our clients make good financial decisions with the best information available. It's not perfect. Mistakes are made. Nobody gets everything right in anything, let alone complex world of money, finances, and investing. But I think working with others, including professionals like financial planners, can help mitigate these behavioral finance and cognitive biases. So thanks for listening today. Hopefully I didn't come off as holier than thou. I don't mean it that way, but I do feel good about my training as a certified financial planner, the work I've done in understanding behavioral finance, including reading lots and lots of books. In the next episode, I'll share some of those books. They're a little geeky, but I will share them. Thanks for listening today. I really appreciate it. Go to the website, elliottwealth.com. Get more information about the work we do here, helping our clients win with money. Subscribe to the podcast. Would love that. And I'll be back with you on the next episode of the Simply Financial podcast very soon. Thanks for listening today.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.